Good morning, everybody. Mike Tedeschi, investment strategist over at Perspective Wealth Plannings. I will be off next week, so we have a lot to cover in this week's video. So let's jump right into it. Let's take a look here at the four major U.S. indexes. As we talked about last week, we really wanted to pay attention to what was going to happen at that breakout level on the S&P 500, the Nasdaq, the Dow. And what we had was we had a breakout and we had a perfect back test. That level held, and we subsequently have pushed and once again made new highs. We have seen that on the S&P. We saw that play out as well on the Nasdaq there, where we held that support level, and we subsequently have continued to push towards those new highs. On the Dow itself, we did not pull all the way back. We did not really push past the original kind of 2-3 day push, but we have made a nice potential bull flag up here at these highs, so we're going to look for that to, of course, continue to the upside. And, of course, the lagger is still the Russell. However, and as I've drawn here on the chart, one of the ways that you could take a look at the Russell here over the last 2 or 3 weeks is essentially a bull flag because it is coming from below. So this would be a bull flag. And yesterday it had a substantial move here to the upside. So it could be a potential short-term breakout, but we still have that major overhead resistance at that 1600 level that we have to get above and close, and then the next target's up there at that 1700 level. But we are still trapped inside this range. You could still technically look at this as a potential head and shoulders setup. Remember, head and shoulders doesn't mean anything unless the neckline breaks. The neckline's all the way back at that 1450 level. So you can't really say, that this is essentially bearish, or we'll get any sort of follow through unless you get below that level. But this is still that area of the market that's just lagging. The mid, the small cap stocks have just lagged substantially, and we're still 10% off of our all-time highs that were put in at the last year, while the rest of the indexes have continued to make new highs, new all-time highs here throughout the course of this year. Especially is recent time. When we take a look at this of course is concerning, but we talk about the mid and the small caps as being a kind of gauge of that risk-on environment. We like to see them lead because that means people are willing to take more risk. Essentially, when you're buying the smaller and mid-cap stocks, there's inherently more risk in those companies than the large blue chips, so to speak. However, one of the other areas that we like to take a look at is the semiconductors, as well as a gauge of risk, right? It's higher risk zone of the market, and it did make a new all-time high yesterday, as well as the rest of the indexes, and really has made a nice move here over the last couple of months, making that finally break out from that April high. So we do have some leadership in some areas of the market that do show that risk-on behavior. So when we take a look at everything on a technical basis, we got 3 of the 4 U.S. indexes breakout, holding the back test and continuing to push here to the upside. We got leadership once again out of the semiconductor area of the market, and once again the mid and small caps subsequently are lagging. So a lot technically is bullish here for sure. Now, what I really want to jump into here is breadth readings. We've talked a lot about breadth in these videos. I think it's very, very important. It's very difficult to have a very strong market if only a couple names are leading. So while just taking a look at the indexes themselves, right, on the surface gives us a picture. When we dive underneath the surface and take a look at how many names are actually making new fresh 52-week highs and making those breakouts, it can give us a better understanding of the overall market. I think it's very worthwhile taking a look at that. So let's jump. First, we'll start with the Nasdaq McClellan Summation Index. We've talked a lot about this in these videos in the past. We had a crossover that happened last week here. So essentially a headwind for the overall market as we had the breadth readings essentially cross over. However, with yesterday's push here to the upside, some key earnings and the potential that we're actually going to gap up here today on Thursday the 25th, it looks like this might cross back over into positive territory and negate that essentially crossover headwind reading that we had last week. If that does happen, that would be once again a showing that breadth is getting a bit better and is a tailwind here for the overall market on the Nasdaq. So we're going to pay very close attention to what happens here. We've had a number, and it does happen where you get a number of times where it crosses above and below and above and below and above and below before you get that really clear reading in both directions. So this is not at this moment where we're sitting right here with the potential to head back higher. This is not necessarily a big bearish concern. But When this triggered last week, we had a Hindenburg omen trigger as well. Let's jump in and let's talk a little bit about that. Now, a Hindenburg omen is a technical indicator that was designed to essentially show the increased probability of a major market pullback. And it takes a look at the percentage of new 52-week highs against the percentage of 52-week lows. When we look at this chart, we've had a couple of Hindenburg omens trigger here in the last year or so. And both of them actually have led to pretty decent-sized corrections in the overall market. So let's really dive in and take a look at this. What we're looking at is the number of 52-week highs and the 52-week lows that are getting hit here at the same time. And what we have is a trigger that happened at the beginning of last year, like in the middle of January. Market ran for another couple of weeks before ultimately making that rollover. We got back up over that key 3% level that we're taking a look at here. Once again, right before that October crash, we ran up for another couple of weeks before we made that pullback. And once again, here we are above that level, and again, certainly we can run for another couple of weeks, and it doesn't mean that we absolutely have to have a pullback. This is just the last two times that this is triggered. Let's actually take a look at all the data points, and there is a little bit of concern when we take a look. Now, not every single one of these instances is negative, but the first time that we get a Hindenburg omen in 3 months on the New York Stock Exchange, when we take a look at this, the numbers are really skewed in the bear's favor. In fact, 1 week, 2 weeks, 1 month, 2 months, 3 months, 6 months later, we have a negative skew to it, meaning we are positive less than 50% of the time. And it takes a year until we get back to essentially a coin flip where it's 52% of the time the market is positive at that point in time after this first reading. And the risk to reward is really skewed again in the bear's favor. With when we start getting 1 month out, we're only positive 23% of the time, with the average negative reading negative 3.5%, and the average positive reading 1.5%. Or so. 2 months out, we're down 7% with a 1.7% on the positive. And when we get 6 months out, the average pullback is 9%, and the average reward on essentially is about 2.7%. So these are like 2 and 3 to 1 negative risk to reward with a positive reading. Some of these 23, 27, 31%, about a third of the time. So these are very, very negative numbers when we're looking here at the midterm on this after this Hindenburg reading. Now, again, it doesn't mean that every single instance is negative. One of the reasons why these numbers look so scary is because we have had these happen right before some major collapse in the past, right? The dot-com bubble and the housing bubble, we had these readings and big, large corrections. This also showed up at 87 right before the crash. But if we look at we look at the numbers, here we are in like 1996. Here's a Hindenburg omen triggering, and the market runs for another 6 years before anything happens. We've had a couple of these readings here in the past couple of years. Again, the market hasn't collapsed in the last couple of years. There have been those small garden variety corrections where you get your 10, your 15% pullbacks, but we haven't fallen into a bear market off of those readings. So could we be in store for another pullback like we had at the beginning of last year in January? Due to these breadth readings, certainly. Does it mean the world is ultimately going to end and the market's going to go down 60, 70%? Absolutely not. There's another way I'd like to take a look at this data as well. Let's look at the breadth readings of the S&P 500 when we're within 1% of a 52-week high. There have been 2,225 days since 1990 when the S&P was within 1% of a 52-week high. And the reading that we had on Monday is lower than all but 26 of those days, where we only had 39% of the S&P 500 stocks were trading above their 10-day moving average. So it's a very weak reading. Above the 50-day moving average, above the 200-day moving average, and we can see here percentage of stocks at a 52-week high. We are maybe a little over 50 of them are above that 52-week high out of 500 stocks. So, very low percentage. That's showing us a little bit of concern here on breadth, especially when we compare it against, all the other zones and where that's happened here over the last, 20, 30 years. And we dive in and look at the actual numbers themselves, within the S&P is within 1% of a 52-week high, and we have these, breadth readings. Those returns and those rewards were right about 50-50 for pretty much all those months. So that does have a negative skew because the market does have a higher percentage chance of being up than down over any period of time due to the nature of the way the markets work here over the long run. And the risk to reward is, again, pretty decently negatively skewed. So, we come in here, we look out 2 months later, we're positive 55% of the time, average pullback 3%, average upside 2%. You get out to 3 months, we're only positive 45% of the time, average drawdown 5.33%, average upside 2%. So this is just another way of looking at it. These don't look nearly as bad as the Hindenburg Omen readings that we saw from the data set, but moving forward, the S&P returns were all below, their average random on any time frame that you take a look at. So again, breadth readings are really, really important in the overall market because it really shows you the health that's going on underneath the surface. And we do have some concerns here, which have been laid out in a number of different ways. The last thing I want to talk about is the S&P 500 after negative divergence with the S&P 500 and the Russell ratio, which is something that we have had here and we've continued to talk about its lagging behavior. Now, when we take a look at that, we see again another pretty negatively skewed component here right before the pullback in 87. We did have pretty much throughout most of the 90s, really, this showed up. And that's that zone where, again, when we look at the numbers, right, we can still run for another 6, 7, 8 years historically before anything happens. But then we do have these readings still up towards the top. We didn't have any of these readings when we look back at 07. And once again, we have a reading that we haven't actually had in 20 years. This is the first time this has shown up. And in the short term, once again, those numbers are negative, big time negatively skewed, but the market's only positive about a third of the time. When we go out 2 to 6 months later, market's only positive about 55, 56% of the time. And the risk to reward on this is actually the reward is upside. Average reward 9% in the 6 month mark, where the average pullback is only 5.5%. The reason I wanted to show this again is just we talk about the divergence between the Russell and the S&P 500. Well, here's the actual numbers behind it right here. Bottom line, when we take a look at all this data, we still have to take a look at the technical side of things. The market did make a breakout. It held that back test. It's continuing to push here to the upside. There is some concerns underneath the surface, so we need to stay on our toes. We need to be cognizant of that. We need to pay attention. If we were to have failure up in this zone and fall back below that breakout level, the things that we talked about today could certainly, pose, essentially exacerbate the problem without having those major breadth readings. But these things could certainly flip. We could see rotation. We could continue to see strength. We could see those areas of the market that have lagged essentially pushing to the upside and starting to take on leadership. We saw 1 day of that yesterday out of the Russell. 1 day does not make a trend, but if we continue to see that push to the upside, perhaps we could finally negate this base that we have been in, this trading range that we've been in on the Russell, and we could see some leadership out of it. So what happens here over the next couple of weeks is very important. There's no reason to be aggressively bearish here at all, right? We have some negative breadth readings, but again, those can flip. It doesn't mean that the market's always going to go down when we see those. We have to pay attention to the technicals, and as long as we stay above these breakout levels, we should have a bullish view of the market. I hope this video has helped you guys out. As I said at the beginning of the video, I will be off next week, so good luck trading. Next week there is a lot of news coming out. The Fed rate decision comes in. If we were going to see a catalyst for a pullback, that could certainly be it. The market is essentially expecting the Fed to cut rates. If they don't do that, that could put that headwind in place, and that could be a reason why we get a pullback. So I look forward to analyzing everything for you guys in 2 weeks when I'm back. Take care.